Sir, there's a GC right there, Cliff.
Go.
It's piers. We got concrete piers and wood piers.
Yes,
Got
sir.
the checklist. Let's check out the checklist. We
Yes,
got
sir.
it for everything we need.
Yes, sir.
You forget some things sometimes. So this is going to outline, make sure you hit every single thing. What's the
Yeah.
foundation, plumbing, electric, painting,
Yeah.
flooring, everything. So you don't
Okay.
miss anything.
Okay.
You want to make sure you
Okay.
get all your checks.
Okay. Y'all want to introduce you guys to Cliff Hunter. Cliff is a world-renowned flipper. He actually flips. He's also a GC as well. He's a good contractor. When it comes to all of our renovations, all over the nation, you'll talk to this guy right here. My whole thing is, one thing I hear a lot of the times when it comes to anybody in real estate is, I don't have the money or the credit or the time or the intellectual property. And I said, oh, okay, no problem. I have the money, have the credit, have the relationships. I'll teach you how to locate a good deal, right? Buy below wholesale.
I love that.
And once I teach you that, right, I'll bring me the deal.
Yeah.
I help you underwrite the deal, which is fine. I'll even fund the transaction for you as well. So there's no excuses on the table at all. That's why we call that the cash flow club, period. So what happens is people always ask me all the time, Dale, can you train me? Well, I don't have the time to do that. But what if I set up a platform for it to where you get on-demand training? Anytime you want to, because the training you may need may be after you get off work, early in the morning, during the day. You just log into your account and get the same training as if I'm sitting there one-on-one. We're talking about our attorneys, our general contractors, our appraisers, as well as me, talking about how to structure your business, how to put together what they call a power team. A power team is very important. How to put a deal together, right, and buy it at the right price point. How to market. That's one technique that people don't understand. That you can actually get a list of properties that from your city for free.
Whoa. So walk me
yeah.
through that. Like, you can physically get buildings or homes or properties available for free?
Yeah, I'll send you guys the bill in the mail. It's real simple. What you can do is you can actually call down to your city and ask for the violations division. What happens is you say, hey, I want to see what homes in our city actually have violations. What are violations? High grass, no paint, vacant. You have boards on there. Those are actually violations that the city or citation that the city has actually levied against that property. They'll give you that list for free. It may be a little bit of a fee, maybe $100.
Sure.
But it is what it is. Then what you do is you actually you can contact those sellers of those properties one-on-one.
Wow. And that's how you make your money. That's
one way.
That's one way.
That's one way.
If you'd like to learn how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below, swipe up, DM me the word to real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner and download the ebook today.
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refi to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What do you do, y'all? It's your partner Dale and Cliff back in the saddle again for another edition of the Investor's Edge here on Friday. And it's a little bit earlier than we normally do, guys, because we busy. We got families and this we running, man. So it's been a very good emotional week for your partner because my baby is in college, y'all. She gone. So pray for your mans and them. You know, I'm gonna make it through this one. Cliff. But it was kind of tough.
Oh,
but anyways, man,
first,
doing all right,
first
brother?
week.
First week, man.
Yeah, doing good, man. I know it's tough to see baby girl walk out on herself, be independent, got her own spot now. She got her own spot. I know you're going through it, man. I got a little, so I got a long way to go, but I can already understand it though.
Yeah, man. Hey, I didn't cry. I didn't cry, y'all. It's all good. I didn't cry. I did get a little emotional, you know what I'm saying? But I didn't cry. It's all good. It's all good. I was proud of her, but also I was sad because she had left the nest and she's there on her own. And so I'll be up there in a couple more days, guys, because I have to get her a couple more things. I can tell you right now, if you are, let you guys know, when it comes to a college student, the bills don't stop. They don't stop. They get bigger and bigger and bigger. So I'm like, damn, I mean, woo, 45 racks, y'all. 45 racks. And that was lower than her first choice, which was 94,000. You know what I'm saying? So I'm like, nah, I'm good, man. But man, baby girl doing all right, man? Wife doing all right?
Oh man, blessed, man. Blessed, man. Yeah, a lot of circumstances, especially this past week. But blessed, man. Blessed to be here, man. So we doing good, man. Can't complain.
Good, y'all, man. We're gonna get in, get out, y'all. We have a really good show for you guys today, man. We're talking all things real estate today. We're talking about, man, tokenization. So Cliff, man, let's dive into it, guys. And we're gonna revisit what we normally talk about because people have been asking about the current market analysis stuff. Yes, you could, guys. Do us a favor, like, share, and subscribe. If you're on a platform, get a little bell. Click on the things when we become live, guys. You can kick it with us, with your partners, man. So, real fast, Cliff, before we jump into our topics, hold on. Here's our topics for today. Number one, guys, we're talking about, man, ABC came out and said that there was a foreclosure surge coming on. Yeah, we have a licensed appraiser on the screen. We're going to see if it's cap or if it's real, all right? Number two, guys, we're going to talk about, man, assumable mortgages are back. They never left, but they're back with a vengeance, guys. All right, vengeance. We're gonna tell you why. Number three, guys. Y'all, we're in a fractional reserve lending type of scenario. Hey, we got tokenization, guys. We got a cryptocurrency expert on the screen. Not your partner. It's Cliff. Cliff is in cryptocurrency. So we're gonna talk about tokenization of real estate, man, and how it is going to potentially unlock a $52 trillion real estate market. Ooh-wee, that's with a T. Not with a B or M, with a T, guys. We'll dive into that. But Cliff, man, back by popular demand, man, the current market analysis. What's going on with the market, man? Talk to us. What's going down, big dog? Talk to us.
Man, it's pretty much kind of the same situation. I think I'm starting to see a lot more foreclosures coming through. Market is, man, it's soft. The best way to say it's soft, right? Yeah. We're seeing less transactions. Less people buying, less movement, and it's just as low. It's the lowest we've ever seen. Well, I would say probably in the last 60 years.
Wow.
Wow. Nobody's buying. If you are in the market to buy right now, right? You've got money when people don't. Yeah. You can get lower interest rates when people can't. Yep. You're kid in the candy store right now. You can go get your choice of house.
You can.
I've seen a house that would typically go maybe for 2.8 going for 2.1.
Whoa.
House that would go for 650 going for 450. We've dropped a lot since the high, but for the most part, it's stabilizing, but it's still soft. You can throw out some offers, and you can get a lot of them accepted. I mean, if they're selling now, it's probably because they need to sell.
Yeah, I can agree. I located a property in Fairview, Texas, which is near Allen, Lucas, Collin County area, guys. Cliff, it's a 5,000 square foot home. 553, right? 5 bedroom, 5 bathroom, three car garage. It was 543. My bad, 543. Sitting on 1.5 acres, and is vacant. High grass, and PenFed is the lender that was looking to foreclose on it, but it's in the midst of a temporary restraining order. That's the third one, and they are frustrated. So that's been going on a lot, guys. Okay, so. Whether it be an affluent area or a non-affluent area, right? Marked properties tend to be on the market a long period of time. You agree, Cliff, or you disagree?
Yeah, I mean it's crazy. Yeah, days on the market are going longer. I'm starting to see them stretch out. It's just not a good time for. I would say the past about 4 years has not been good in real estate at all. And we saw a plunge. It went from really good during the pandemic. Yeah, it was flying. And it just dropped off, and we haven't seen it since. We've seen interest rates come down and then go back up again.
Yes.
So they're in the high sixes now, 6.7.
Yeah.
6.8.
I agree.
And I keep saying it, until we get below 5, we need to see 4.8s, because then we know you can easily get a buy down to 3.8.
Sure.
Easily. So until we see sub 5, we're not going to see the market come back. And I'll say this, I probably have the conversation 2 to 3 times a week from somebody who's in an interest rate 2, 3, or 4%, who said, I'm not leaving. It makes no sense. And so that tells you the broader market is thinking the same thing.
Guys, he ain't lying. And I'm going to say it with my chest, y'all, for the folk in the back row. We ain't getting down to no 4s. That ain't happening. Nope. We are right. We're going to be at the 6.5% for a long period of time. Get used to it. This is the new normal. It's the new normal, guys. It's not going down. No matter what Trump tell you, whatever, no matter what a politician tell you, it is not happening at all. Understand that. So what does that mean for a buyer? You're in a very strong position to where you can ask for a lot of concessions. Be very creative, right? Cliff, I had a friend member of mine, my aunt, bought a new construction property, Cliff, for 0 down using the FHA product. 0 down, because the builder gave her so many incentives. They put down an earnest money of about $3,000, right? Went in that, and this includes all appliances, Viking appliance level, up there. Yes. Right. And I said, whoa. And what happened at the close, Cliff, they signed and they said, you need anything else? Nope, we're good. Oh, matter of fact, hold on. We need one more thing. So what? They gave them a envelope. Cliff, it was the refund of their earnest money. Yes, sir. Because of all the incentives that they received from the builder. This is in H-Town, Houston, Texas, gal. Yeah. Yes. So what Cliff is saying, he ain't lying. This is a buyer's market for a long, I think for the next 5 to 6 years, it's going to be a buyer's market. Buyer's market.
Probably. And there's not going to be new inventory much because people aren't moving. They're not going to sell 3%. It just doesn't. They're going to rent it out. They're going to rent it out, and they're going to keep, so, and there's not going to be a lot of new construction on the market either. No, because they can't build for the value they need to.
Yeah. My boy Aaron on good to see you, Aaron, brother, on Instagram says that, hey, but we need the jobs to pay more though. Yeah, I hear what you're saying, Aaron, but unfortunately right now the cost of capital for the businesses is higher, and they're using AI to eliminate a lot of jobs right now, right? So with that being stated, why do they need to up your salary? They are eliminating a lot of jobs so they can run it more efficiently with a lower price point as far as when it comes to cost of running the business, because it costs them more to borrow the debt to pay you. That makes sense.
Exactly.
I'm off.
No, you're right. And your boy Aaron, obviously everybody wants to get paid more. I mean, the NBA players talking about they need an extra $1 million. You know what I'm saying? Yeah. So everybody's in the same bucket trying to get more. But like Dale said, with the cost to borrow money being twice what it was 6 years ago, they have to make that up somewhere. And they're probably making it up in people's salaries. They're making it up by cutting costs, implementing AI. They're doing a little bit of everything in order to try to make up and get that profitability back. Got to.
Yeah. It is what it is, guys. It's just, guys, we want to give you guys, we want to be honest. Want to be honest, guys. Want to be honest. It is what it is, guys. But that's current market analysis, guys. Let's dive into our first topic for today, Cliff, man. Yo, guys, there is a foreclosures surge. ABC is saying this. We not saying this. ABC is saying this. All right. So the good thing about it is you have an investment banker and investor on the screen. That'd be me. You have a licensed appraiser, right? Cliff, that'd be him, and an investor as well also. But boots on the ground. We're going to see if what they talk about is cap or real. Deal, Cliff?
Yeah. Let's take a look.
Okay, let's just get into it, man. Let's go ahead and get to it, guys. Here's the guys from Revent Your App, guys. Trust these guys. They're cool. Love them to death. But let's see what he's talking about real fast, guys. Let's get into it. Here we go.
ABC News is reporting the biggest spike in foreclosures that we've seen in America going back to the end of the last housing downturn, with ABC News reporting that foreclosures are on the rise nationwide, up 21% year over year. Additionally, they're up 28% from 2024, with foreclosure filings increasing 71% between 2020 and 2025, with the foreclosures occurring most in the areas in red on this map.
Whoa,
now, the
Texas
foreclosure levels we're seeing today are not nearly as high as they were in 2008, 2009 in the midst of that crisis. However, they are now starting to cause sellers to have to cut prices by a lot. For instance, this house in Florida has been marked down 45% on value. It's a short sale. You can see the massive decline in the Zestimate over the last 2 years. This house sold for $394,000 in January 2023, near the top of the housing bubble, and now it's listed at $210,000. $184,000 loss, or a 47% decline. Now that's quite literally the type of declines we saw in that last housing downturn in 2008, 2009, which is pretty interesting because many of the people in the housing market are still trying to tell us that there is no housing downturn. They're trying to tell us that there is no real mortgage distress, yet the data is becoming hard to ignore. And I want to show you guys where this mortgage distress is coming from and where you need to be concerned. Like if this is happening in your neighborhood or your city, this is coming largely from FHA mortgages. You could see this graph from ICE Mortgage Monitor is showing that the delinquency rate on FHA loans, which are those low down payment first-time home buyer loans, they have spiked over the last year. Seriously delinquent is now about 5 to 6% of these mortgages. If you exclude the pandemic increase, that's the highest delinquency rate we've seen on FHA mortgages since 2014. In addition, you could see that these delinquencies that are turning into foreclosures are happening for newer vintage mortgages. These active foreclosures are surging for loans initiated between 2022 and 2026, these green bars here. So it's people who bought recently that are going into delinquency and foreclosure. And that makes sense, right? Because the people who bought in 2022 and 2023, right when I was warning you guys about this housing bubble initially, warning you that the market was overpriced, that there was going to be a correction coming, it's the people who bought around this time that are going into foreclosure and default, because when they bought at excessively high prices and elevated mortgage rates. So if you bought in 2022, you bought like at that peak price with a 6 to 7% mortgage rate, most likely, meaning very high payments, meaning a very high debt to income ratio. And unfortunately for a lot of the people who bought around this time, it's just not working out. And if they're running into even just a little financial distress, it ends up in a foreclosure. And in a second.
So Cliff, man, brother, what you think, man? What you think? What's going on? What you thinking, brother?
No, he's right. So I've been actually, I work with the with Fannie Mae. I work with USDA, and I can tell you that's happening predominantly in new construction, because what's happening not only is what exactly he explained that's happening. Foreclosures going up. Like I'll give you an example. I've probably done maybe 8 in the past 2-3 weeks. Foreclosures. And I have to put that on the report. Foreclosure. And what's happening is you can see the tax spikes. When they first buy a home, what they do is when they plot all the different lots, they'll give it a basic tax rate. Let's say $2,000-$3,000 for the year.
Yeah.
After a cycle of a year or two and the subdivision is developed, that tax rate will 5x sometimes. They'll go from $2,000-$3,000 to $9,000.
That's correct.
And people don't realize with the taxes that when they see $2,000-$3,000, they go, oh, okay, it's $2,000-$3,000 a year. And they don't realize that there's going to be a jump in their tax rate, that's just a supplemental rate that the county will put on until they evaluate the real value. Because when it's a new construction, they don't know.
Wow. Man, you're right. I think people, we got a question here. It says, as I'm wondering, are the people that just purchased in 2025 are struggling? Yes, they are. They are struggling. The reason why they're struggling is because banks became more lax on their qualifications to be able to qualify for a mortgage, right? So a higher DTI, right? Of course, they're paying a 6 or 7% interest rate, right? And again, these are FHA loans. So they're putting down 3.5% down. And so, as Cliff said, if they're doing new construction, they come into the closing transaction, right, with a certain interest, with a certain taxable tax bracket when it comes to their property. Well, 2 or 3 years down the line, guys, what happens? It adjusts up because more properties have been built, and now they're paying a high. For instance, I know in Prosper, Texas, which is a very affluent area in Collin County in Texas, a lot of people did not plan for that tax hike, property tax hike, because they planned for that beginning tax rate when they bought the new construction property. Well, that place developed fairly quickly, right? And now people are exiting Prosper and even Salina, because of the taxes, property taxes. They didn't properly plan. Would that be kind of right, Cliff? You disagree?
Yeah, exactly. So I think that's happening more. And the houses are vacant. That's the other part. It's not like there's people in them. People have already left. So I would say 9 times out of 10, the house I'm going to is vacant. And I mean new construction. Matter of fact, I did one today. Yeah, they're almost all new construction. You walk in. So for example, when you do a new construction, a lot of times you have to do what's called an REO addendum. And so on there you have to put anything that's wrong with the property, right? You have to mark down if there's anything wrong. So you have to let Fannie Mae know. I'm telling you, 9 out of 10 times it's nothing. There's no movement. There's no cracks. It's new construction. Yeah. And so I'm having to write none in the addendum because the property is brand new.
Yeah.
So that's happening more and more.
It is, guys. It's a tough market right now. It's very stagnant right now. It is. So I would say ABC is actually correct. They're right about this. It is a foreclosure surge going on. And as you hear from a licensed appraiser, that it's more so new construction homes. Yeah. Yeah. Because remember, guys, when builders sell that property to you guys, they're funding it with their warehouse line of credit, and then they're selling that note on the secondary market the same day or the day after. So that didn't affect them at all. They made their coin already. But the problem with this when it comes to new construction, with new construction builders, is this here. When there's a lot of foreclosures, what happens, it makes it hard for them to continue to build. It does, because the money's not working, because no one is buying. So then you begin to see a lot of new home builders begin to build properties, right? To get the money working, in hopes of someone to come out and buy the already built property as they walk through it. But that's not working out as well. Also, it's not. All right, Cliff, am I wrong?
No, you're right. Now, the interesting thing is those lower priced properties, those cheaper properties, talking about 3-2 under 1,500 square feet.
Yeah,
they selling. I did one today. I did 6 with Lennar, and they selling. Like, so if you just stay, if you stay on that lower bracket, find the average in the area, and you can start looking at different metrics, top quarter, bottom quarter. But if you're on that bottom third price point, those just sell.
Yes,
they sell easy as long as it's fixed up and it's nice. I've noticed that maybe the values don't rise as much, maybe a lot of other factors, but they sell. People buy those because the interest rate is less valuable when you're talking about a $200 to $300 difference. People can absorb that. It's when you start getting the $500 to $1,000 difference, you start to see that they'll make different choices.
Yeah. So again, guys, he's right. We'll give you guys some game. If you're a buyer, hey, you basically get what you want. Within reason. But go out and get an aggressive realtor, an aggressive lender, and go get what you want to get, guys. But make sure you get a lot of concessions, specifically on the rate and the price point, because you're most likely to get it. Because they have no way to sell it. They don't.
All right.
They don't. All right, guys. And that one was kind of hard to listen to a little bit, guys. A lot of people. Now, let's go to the second one, guys, here real fast, man. Assumable mortgages, man. They are making a comeback, y'all. They are. Now, they never left. They've been here the whole time, but they've been very rarely talked about, Cliff. Would that be right, man? Very rarely talked about, consumer mortgages. And they're making a comeback and a half. And realistically, that makes sense. We got another question on here. It says, this is true. I'm seeing 3-2s are jumping off the market, but 4 or 5 bedrooms are staying on the market a lot longer. You're right. Yes, sir. They are. Again, we're announced from an active investor as well as another active investor, and also a licensed appraiser. Both there. They're right there. Seeing it. Now, here we go. Let's dive into this next topic, guys, real quickly here. Assumable mortgages. Here is a video, guys, talking about assumable mortgages. They're coming back with a vengeance, guys. And to be honest with you, it kind of makes sense, to be honest with you. It makes some sense, in my opinion, because I don't know about you guys, Cliff. If I can get a property, assume somebody's mortgage, and go through the same qualifications, right, that I'll go through when it comes to buying a new property, but I can assume a 33% mortgage, would you do it?
Oh, yeah. All day.
All day long. Here we go. Let's get into it.
My wife and I have been looking for a new home for the last 2 years.
This is Wes Vandal. He is a new homeowner who is facing many of the same issues other prospective homebuyers have faced in this hot housing market.
We really just hadn't had much luck, mainly due to increasing interest rates driving up the cost of our mortgage. We did put in a couple of offers that didn't go anywhere just because it's a very hot housing market here.
But the Vandal story is a little different than most homebuyers navigating the market right now.
We found one that popped up. It was the right size, it was the right area, but we knew it was a little bit out of our budget just because the interest rate was too high. Just happened to look at the Realtor app again, and there was a button on that app that said, "This home has an assumable mortgage."
What the Vandals found is a rare type of mortgage called an assumable mortgage, landing them a 2.6% mortgage rate as opposed to the 2024 average, which sits just above 6%.
An assumable mortgage is a type of home loan where the buyer can actually take over the existing mortgage terms from the seller.
That meant a difference of over $800 a month.
A common occurrence in the 1970s and 80s, assumable mortgages are a rare find in today's real estate market. In 2023, only 4,052 Federal Housing Administration mortgages were assumed. That's still a 59% increase in FHA mortgage assumptions since 2021. For Veterans Affairs mortgages, the jump is even larger, with 2,244 mortgage assumptions in 2023, an increase of 713% compared to 2021. And 2024 assumptions are already outpacing previous years for both the VA and FHA. So what are assumable mortgages? How do they work, and why aren't they more common?
So Cliff, man, real fast, man, that's a long one, guys. Assumable mortgages, Cliff, man. If you could, let's let people know what assumable mortgage realistically is, so they can understand exactly what's going on. What's assumable mortgage?
Yeah, it's exactly what it is. You're just assuming the mortgage. You're basically taking the mortgage and putting it in your name. We talk a lot about sub 2. That's when you put the deed in your name.
Yeah.
This is when you actually take the mortgage itself and put it in your name.
Correct.
And it's basically like you're applying for the mortgage, except the mortgage will go to you instead of being paid off.
Correct. That's exactly what it is, guys. That's exactly what it is. Assumed mortgage is just what Cliff just said. That's all it is. You're assuming someone's mortgage, qualifying for, like you would normally qualify for a traditional mortgage, right? Just at the closing, instead of you going to close, so to speak, traditionally, it's just assume their mortgage. All you do, that is it. It's a traditional way of a subject to, but a subject to is different because the mortgage stays in the person's name and you just take over that payment. This is different. The mortgage, it changes from that person's name to you. It's real simple. It's not hard at all. And I don't know about you guys, it actually coming to where you can take over someone's mortgage at a 2.6% interest rate versus 6.25%, 6.5%.
That's crazy.
That's 4%. That's 4%, Cliff. Yeah, that dude say he's saving $800 a month. Jesus.
But he's taking over the mortgage. So how does that work if there's a difference in the purchase price? Let's say he's buying it for $400,000 and the assumable mortgage is $300,000. He has to come with that difference in order to do that. That's the only way, unless he gets a HELOC or something like that, second mortgage or something.
So what you're saying is it's still a sale per se. So if the assumable mortgage is, let's say it's $150, and the sales price is $200,000, they'll agree to that's $200,000. He assumes the 150. He has to bring down $50,000 down.
Right.
That don't make no damn. Like, why would they do that for?
The only way to do that is to get a second. It's probably go get a second to cover that difference.
Yeah. Because
you got to think, unless they're selling it for exactly what the mortgage amount is, or something close to it, that's the only way. Because I'm assuming there's equity. I don't know, but that's how it has to happen. That's why they're hard to do, because you have to make up that gap. And unless you have a second mortgage lender, then it's not that big a deal. If you get somebody who can do a second, you straight, you cool. But if you don't, then you got to come with that money.
Got to. I mean, I can see that. Would I do that? Most likely, probably not. Got to get another question that says here. It says, "Is a down payment required, or is a down payment required, or you're just bringing the loan current before assuming the loan? Now you have to bring a down payment. There's a down payment. There's a down payment that's actually needed for that. Yes, it is. This is not like a. Again, sub 2. Not taking over someone's mortgage. You are just assuming their terms while still buying it from them. Does that make some sense?
Yeah, because I think the problem is for a lot of people, there's two different parts that are operating. One is the deed, and one is the actual mortgage itself. And so sub 2 is when the deed transfers, and assumable mortgage is when the mortgage transfers.
Correct. That is correct, guys. But it's making a comeback. It is, guys. It never left, but it's never used at all. And people are now, Cliff, hypothetically, then real fast, would that assumable mortgage be included in the FHA type of scenario?
Yeah, I mean, if you can, because you have to figure out who their mortgage is, obviously what's the amount, and then you have to fill out their application as if you are applying for that mortgage and still go through that process. So you still have to go through all those steps in order to really take over that mortgage. It's not as easy. It's a harder process to do.
It can be a little bit more challenging. That's the reason why it's not really talked about a lot, because of the difficulty of doing it, versus an easier, cleaner way of just buying them. Just buying it. That's it. Either way it goes, you have to bring some capital to the table, which is fine. You want to have your own mortgage, or just assume someone else's mortgage? It's up to you. It's what it is. Up to you is what it is. Man, that one's pretty good. Now, guys, let's go to our last topic real fast, man, and then we'll be done, guys, real quickly. Yo, hold on, not that one. Oh, here we go, guys. This one I'm pretty excited about. The reason why is because of the fact that we're in a leverage-based system, guys. Okay, and tokenization has been talked about for a long period of time now. All right. But I want to break this down in a way to where it makes sense to the audience, because people don't understand what tokenization realistically is. All right. So Cliff, give them a short definition of what tokenization is before we introduce them to how banking works. Go ahead.
So tokenized is like, basically you're already doing it. Your money that you have with your bank, that's not real. That's numbers in a computer.
Yes.
That's it.
Yes.
And so the difference between a tokenized dollar and the bank dollar is the bank controls that dollar.
Yeah.
It's in their account. They're holding it for you. It's basically theirs. You just have access to your money. A tokenized dollar is 100% yours. Nobody else has access to that dollar except you. There's no intermediary bank or somebody else holding it. It's just you. It's just your dollar. And you're just holding the digital version of that. The bank's doing the same thing, but they're just holding it for you. Tokenized is you hold it yourself through a ledger. And it's the same. It's basically the same thing.
Makes total sense, guys. That's exactly what it is. That's all it is, guys. Now, order for you to understand tokenization as a whole, we have to visit how real quickly this leverage-based system that we're in, because Cliff just said up front that what the bank doesn't have real money there. It's just digits. It's what they call fractional reserve lending. So let's revisit that real fast, and then we'll take a little bit of a deep dive on tokenization. Here is a video that I want to show everybody real quickly, man, that kind of gives a short synopsis of what this is, guys, and then we can kind of go a little bit deeper. But this is what they did. Let me get rid of this real fast, guys. Here we go. Here is what it kind of looks like. Let's get into it. Here we go.
So if you deposit $10,000 into the bank sets aside 10% or $1,000 and then loans out the rest of your money. The way it works is, say another person comes into the bank and asks for a car loan of $9,000. At this moment, the bank loans out the $9,000 from your original deposit. It isn't there anymore. The borrower then pays the person selling the car, and they go deposit the money into another bank, which is part of the same central banking system. This $9,000 is treated as a new deposit, and the process continues. The money gets redeposited and reloaned until the initial deposit of $10,000 becomes $100,000. The banking system just created $90,000 by loaning out your money.
That's all it was. That 90,000 guys is not real. It's made up. Am I right, Cliff?
Exactly. It's made up, so you don't have the money in your account, and that makes the bank have to make very wise choices because they have to get cash flow. That's why the bank is very conservative with their money. Very conservative.
Exactly. Now we understand that that's called fractional reserve lending. It's a 10x scenario. If you have $1, they can loan out 10x of that, 10% to more of that. All right. Now, let's go over here, guys, to this is my theory. All right. My theory is this here is I believe that when it comes to this Iran war, this was a way for Trump to try to reset the entire financial market, to be able to digitize it. Now, him and Biden shook hands here because Biden fast-tracked what they call Fed Now's whole thing was to replace Cash App, Venmo, and things of that nature. Trump kind of flipped that on its side with the Genius Act, with stablecoins, right? So I want to show you guys what I believe Trump's true intention is real quickly, and then we're going to pivot over to how tokenization fits with this fractional reserve lending scenario, and also this whole thing that when it comes to the resetting of the financial market. Here we go. Let's just get into it. Here we go. Oh, boom. And there we go. And come on. There we go. Here is, let's get into it. Here we go. Come on, play for me. There we go.
Trump is about to turn every smartphone on the planet into an American bank account, and it could trigger the greatest economic boom in American history. It's called a stablecoin, a digital dollar anyone on earth can hold with nothing but a phone. No bank required, and it moves across borders in seconds. Here's how that makes America rich. By law, every stablecoin must be backed by real dollars and U.S. government debt. So every person in Argentina, Nigeria, or Turkey who swaps their collapsing currency for digital dollars forces more American debt to get bought automatically. Now scale that up. Billions of people holding dollars for the first time ever. That's the largest expansion of the dollar in history. America prints the money, the entire world lines up to hold it, and the debt gets funded by global demand instead of American taxpayers. Other countries export oil and cars. America is about to export money itself. That's the boom almost nobody sees coming, and it's already being signed into law. Follow us to...
So Cliff, man, what do you think about that whole breakdown, brother? You agree or disagree on that?
That's exactly right. That's exactly right, man. Pay attention. Watch that again. Clip it. You know what I mean? That's 100% what's happening.
Guys, so now you see the fractional reserve lending got us in a situation where we owe a ton of debt, right? Now what's happening is now you got, what can you do with this debt? Because we actually owe over $200 trillion in debt, not 39 trillion, 200 trillion debt. We actually have 7.6 going out, 5.4 coming in. That's $2.2 trillion in arrears. That's unsustainable, right? And in a $39 trillion debt, Medicare, Medicaid, and Social Security are not involved in that figure. That's what they call off balance sheet accounting. If you and I actually did it, we go to jail for fraud. It's literal fraud. That's what it literally is. But the banks do it all the time. So how can you inflate the debt away? Because if you saw the video, they talked about expanding the dollar. How can you inflate it away? Simple. You pivot over to a digital dollar. Stable coins. In walks tokenization. Why? Because tokenization is a $52 trillion real estate play. That's with a T. Okay? Listen to this real fast, guys, right? Listen to this real quickly. Then this is on CNBC. So this is a reputable organization, all about business, right? They go into a little bit of synopsis about this. We're going to listen to the first part of it. That's it. And then Cliff and I are going to give you guys our thoughts on this, and I'm going to let Cliff cook. Because this is the Cliff loves this stuff, right? Here it is. Let's get into it. Here we go.
This is New York City's East Village, and I'm standing in front of 13 East and West. In 2018, it was Manhattan's first property to try a new approach to ownership. Fractions of the condo tokenized on a blockchain. The effort was put together by companies Propeller and Fluidity as an alternative way to finance the development. The move was lauded by the Web3 industry as a way to take the technology mainstream, but the project ultimately failed.
A lot of people still don't really understand, what are the tokens? What does that actually mean? And it's just sort of a novel concept.
Despite that setback, there are companies operating today that believe the technology can change how we interact with real estate. They're on a mission to let homeowners more easily tap into the value of their homes, or even just let people buy real estate in a time when many feel it's harder than ever to purchase property.
So Cliff, real quickly, they'll go a little bit more deeper, guys. I don't want to confuse the people because they go deep. Well, here's my question, Cliff, concerning this real quickly. Tokenization, man. In that play, talk to them about what that was real quickly, and also how much capitalization can actually be created via tokenization. Talk to them about that.
I mean, yeah, tokenization, like when they tokenize real estate, it's just shares. That's all it is. It's just shares. So if you have a house, and let's say me and Dale, we own half, he owns half the tokenization of that property, I own the other half. That's it. So it's like the shares of a company. Dale owns half the shares, I own half the shares. That's really all you're doing. So when they did the condo, they're just breaking it down how they normally would. Typically, you get a piece of paper that says this is your share of the condo. Cool, you own this property. Tokenization is the same thing, except we're taking those shares and that piece of paper and we're making it more tangible. We're giving you a portal you can log into where you can see how many shares and what's owed. The problem is if people aren't technologically inclined and they're not understanding how to use the portal, how to sell it, because you can't just sell it for the dollar, you have to sell it for a tokenized dollar. Then you have to learn how to spend that dollar. And so that's a learning process that not a lot of people, most people have never, they may have owned Bitcoin, but they've never actually bought something with Bitcoin. And that's different. It's a different process. And so you're having to train and learn. And so it works. Tokenization works. The only two problems is one, who's managing it?
Yeah.
Who's really managing how everything gets distributed? And number two, how do you get your money out in a way that you can spend? Because if you don't have a Bitcoin wallet or any other kind of wallet, you may have tokens, but it's going to sit into an account until you create a wallet.
He's spot on correct, guys. He is spot on correct. Now, Cliff, and guys, I'm asking Cliff this question because he understands cryptocurrency a little bit better than I do. Okay, I can know enough to be dangerous. He knows enough to do a lot of good damage. Good damage. So here's my question. Explain just for real estate. Explain real quickly, Cliff, how long it would take for, let's say, that condo example, right? To get capital versus tokenizing. What is the timing? What's the difference in time when it comes to capitalization of an asset like that?
I mean, let's say your investors are all savvy. in tokenization. Okay. You can get funded same day.
Whoa, same day.
Same easily.
Whoa. So let's just say hypothetically, we have a property. You know what I'm saying? $100,000 is the valuation, right? Typically, what happens? You can refinance it up to 75%, depending on if it's cash out, refi, right? That normally takes about 21 to 30 days close, right? So when it comes to tokenization, someone can literally structure a tokenized scenario to where it can be funded the same day.
Well, so okay, if you're buying a building, then you have underwriting,
sure,
right? So that's what takes a while.
Sure.
Theoretically, you could use AI, which I think is going to end up happening to do underwriting.
Yes. Mm-hmm.
They're already starting to do that with appraising. They're starting to do different things with that. So if you have to do underwriting, I think in the next 5 to 6 years, you'll see underwriting. You'll see it open to close another 2 weeks.
Open to close in 2 weeks.
Easy. On certain property. Yeah.
That's actually easy. Really fast.
Clean under, because what they'll do is they'll give you a checklist of things they need. You'll fill the file with the paperwork, and then the file itself is an AI telling you, give me this more paperwork, update this, change this. So in real time, as you're loading it, you're getting feedback versus uploading it, waiting for the broker. A day or two later, they ask you. Now, in real time, the underwriter is telling you what to do. So you can have all the paperwork in a day or two, and it already approved you. The AI are cool.
Brokers, your job may be in jeopardy, big dog, because it's coming. It's coming.
Man, look, this is a little off track, just slightly. At the Taco Bell up the road, they are already using AI as a speaker. So when you pull up to order your food, it's just pure AI. So they're starting to implement it in more things.
Yes, and at Walmart, guys, they're beginning to eliminate a lot of cashiers and just have self-checkout.
Yeah.
Just self-checkout because it's more efficient, and you can use staff somewhere else, or even decrease their staff. So they can actually have a pretty huge delta to their profit. Walmart already makes billions. They're killing the game. But if they can make more money, what they're going to do, they're going to make more money. So again, guys, to understand tokenization, now lastly, Cliff, on tokenization, the number that CNBC gave out was $52 trillion. Now, I know you hadn't watched this entire video, so to speak, to understand what that is. That type of figure, when it comes to the real estate market for the U.S., is that wise, you think, or is that kind of grasping for straws?
Oh, that's grasping at straws. To try to tokenize, because you have to understand, like, okay, where's it going to sit, right? More than likely, if you were going to do it in a institutional way, you'd have to get the cities and counties involved.
You would,
because that's probably where the information is going to sit.
Correct.
That ain't never going to happen. Them cities and counties are so far behind. Sometimes the lot number's wrong. I mean, all kind of data is wrong. So you need to clean up the data before you can even start tokenizing it.
Mm-hmm.
So more than likely, you're going to see it in like new high rises, new condos like this, in very specific cases. I think we're a long way away from implementing it across the country. I think we're a long way away.
I agree, guys. That is kind of drafting at straws. That all makes sense, and it's sexy to talk about. But we're probably about maybe 20 years off. We may even have him. That's a big ask. But is it coming? It's coming. It's coming because it has to. It has to. So, guys, it may be wise, and I may put together maybe a cryptocurrency or a tokenization type of course for you guys to understand exactly what's going on. I don't know, just think off the top of my head so you understand exactly what's going on, because maybe the case to where it may not be at the country level, but it may work for your transaction. That's possible if you understand what's going on. So that's it, man. Man, Cliff, man. Go ahead, Doc.
Oh, I was going to say the real key is, if you want to do tokenization, do it right. Now, we were kind of talking about this before. It's to be the manager, to manage the funds, because tokenization is great and easy for everybody, but the hard part is management. So if you become a tokenized property manager, now that's valuable, because you're going to take that asset, and because the money's flowing through you anyway as a property manager and managing it. So if you could do that and say, hey, I have 100 investors, the management company should be able to tokenize that easy.
Wow. So basically what's happening is normally the middleman is on the loan originating side. Now the middleman is moving to the management side now. Now there's also
that's where
the money's gonna be made now. Now property managers are still there now, and I don't really like a lot of them. It is what it is. But for you to actually master that as a manager when it comes to tokenization, you're gonna kill the game. You're gonna kill it.
Oh yeah.
God.
Because think of it this way: property manager now, all they're doing is leasing, managing the day-to-day, but the money that comes in, imagine every dollar goes into the AI, and the AI can sort it and put it wherever it needs to go, and then have an automatic updated ledger that every buyer or every investor can then go and see it. So when you log into your portal, it's just an AI chat. You could ask it, how much money did I make? How much money did the business make? What's our cash flow? How many tenants? And it's going to be real time, real data. That is going to be huge if a property manager offered that.
Huge, guys. Huge. Guys, we gave you guys probably $1 billion worth of game today on this, because this right here is they're already tokenizing mortgages now. That's happening. They're already tokenizing buildings as well as crypto, using crypto when it comes to mortgages. Let me get to the right. Tokenizing buildings and using crypto when it comes to mortgages. That's happening now. Right now. So again, this is nothing. It's no longer theory. This is actually happening. All right, guys. Right. But man, if you want to say anything else, man, before we end, big dog.
Nah, man, you already know. You're always one deal away.
Gotcha. Now, before we leave, guys, we have a licensed appraiser on the screen, man. Cliff, tell them about 100appraisals.com. Tell them about it, big dog.
Man, just go to 100appraisal.com. Give us a call. Contact us. We're gonna help you out. Do commercial, residential, consulting, whatever you need. We might be expanding a little bit more, trying to do higher end consulting with Big Dog over here, so that we gonna try to put something together, because I've been asked on a couple of things that I think it'd be smart to see if we can go for some new customers. But go to 100appraisal.com. We'll work it out.
We will, guys. That's for sure. And Cliff and I are working on something for this right now, for your phone. Now I'm gonna give you guys a little bit of what it is real quickly. What if you use your phone right now? What if you really use your phone, guys, and it makes you a seasoned investor just by using your phone? Anybody. That whole thing's been developed right now. So that is coming. Also, guys, very quickly, guys. Hey. We do have, guys, I like this business better. Hey guys, if you want to get the distress for property ebook, is free right there on the screen. Scan the QR code, click on the link below, guys. Right there. Go get it real fast, guys. All right. And then lastly, Cliff, man, me and Cliff are putting together some type of consulting thing that he was talking about as well, for us to have a more of an experience. We'll set up a community to where we can have something you can learn about tokenization, subject to investing, distressed property investing. All that is kind of set up already, but we kind of put everything together, and give us about 60 days, 60 to 90 days. It's gonna be rolled out, guys, and for those that have been rocking with us for a long period of time, you're gonna get first dibs at an extremely nice discount. Okay, extremely nice discount. All right, guys. Cliff, you want to say anything, man, before we get up, you know?
Oh man, enjoy y'all's weekend,
guys. Man, thank you so much for that. God bless you, guys. Man, you know we end it every time, baby. Before you leave, while you can. You see that thing? I like that hat, man. That hat is clean, bro. New York, man.
Get them standard ones.
Hey, man, it's clean, yeah, but mine look better though. Mine look better. All right, y'all. God bless you guys. See you guys next time, guys. All right, y'all. Peace. What's good, guys? It's your partner, Dale. here, man. Hey, I always say that when it comes to real estate, I think this is the best time. The next 3 to 5 years is the best time, in my opinion, to begin to invest in real estate. Whether you are a seasoned investor or a novice investor, this is the best time, in my opinion, to invest in real estate. Now, why would I say that? It's very simple. Whenever there is some stagnation within the real estate industry, that's the best time to get deals, right? Deals are what attract the capital, right? A good deal will always attract good capital. Now, what's a good deal? Well, I like buying distressed properties below wholesale. The skill to buying right is learning how to locate distressed properties in your city, county, or state. Now, the good thing about it is we are giving away a free ebook called Distressed Property Investing. We talk about different ways of locating distressed properties in your city, county, state, what to look for, who to call, things of that nature. It is free. Once you master this type of skill of locating distressed properties, you'll never be broke ever again, because good deals attract the right capital. All right, guys? So to get the free ebook, click on the link below, scan on the QR code here on the screen, or you can DM us the word real estate and my team will get you out this free ebook. Again, it's completely free. Just want to get you this information so you can begin to get the bag while buying real estate. Stay blessed.
Okay, so you did fixes and flips first, or were they, now it sounds like you're more buying whole. Okay, so you're wholesaling first. Okay.
Because I was broke. I had no credit, I had no money. So I had to get some money coming in. So I learned how to do wholesale.
And you were doing wholesaling at the good time too.
2000.
When it wasn't so saturated. There was.
I kind of saw the debacle coming. Okay. It didn't make any sense. I was like, wait a minute, how can you lend out to retail buyers 99.7%?
Yeah.
Just a little bit of a down tick, it's insolvent.
And you got to remember, in some states, because I lived in Florida at the time, you could have loan to value above 100% of your property.
Right.
The first property that I bought, it was 110%. We left the bank with like $30,000.
Yes.
Yeah.
Yes.
It was amazing to me. I was like, why am I not doing this all the time? But then clearly 08, 09 let me know why people shouldn't have been doing that all the time.
08, 09, that's why I made that lion's share of my money.
Wow. Okay.
Actually running from the cows, I was running to it.
Of course.
Because I saw it was coming.
Okay.
A lot of my business colleagues back then were buying flippers.
Yeah.
I didn't think it was wise for me to share 50% of my profit with Uncle Sam. He ain't do no work.
Okay.
So why would I give him free money?
Of course.
Okay, how can I make sure I'm still legal, but keep the lion's share of the cash flow?
Of course.
So I began studying the tax code with my accountants and CPAs, and I said, okay, I'm going to buy a whole lot of properties. Now watch this. I actually buy a lot of properties. I take home money when I actually acquire it. Every single time.
Okay, you need to break that down just a little bit.
If you'd like to learn how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below, swipe up, DM me the word to real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner and download the ebook today.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.